Hi, good afternoon friends, and welcome again. In this video I will be talking about some more details about profit and loss account which I shared last time. So I've written a few pointers. See, firstly we understand basically what profit and loss account is. Now in preparing profit and loss account one needs to also understand how to treat various entries in the profit and loss account. Now last time remember I shared with you an interesting equation that assets is equal to the liabilities plus contributed capital plus the revenues minus the expenses. This is the simple equation. But if in this you take care of the withdrawals also, because there are certain dividends which are paid out or any other form of payout to the shareholders, then the equation changes further. So it becomes assets is equal to liabilities plus contributed capital plus revenues plus expenses minus the dividend payout to the company. Now what it means basically is that the total assets in a company at any point of time would be made up of finally the capital. Now capital could be either the loans from somebody in the form of any bank loan or anything, or it could be the contribution capital by the promoters minus the expenses. So this is a small equation. Now if we rewrite the equation and change and try to understand, for example, if I rewrite this equation as assets and bring the other variables like expenses and dividends, so assets plus expenses plus dividends will be equal to the liabilities plus the capital or the contribution capital and revenue. So what it means on one side of the balance sheet, which I call the left hand side of the balance sheet or the P&L account, we will have things like assets, expenses, dividends. So basically this is something which we have, or the tangible thing. It could be the things which we have spent either in terms of acquiring the asset or expenses or dividend paid out to the shareholders. It's all a form of an expense or something acquired. And how we got this? By spending or taking loans, that is liabilities, and contributing the owner's initial capital and also the profits which have been made by the organization over that period of time. This is a simple but a very important equation which we need to understand. Okay, now the entries on the left hand side of the P&L are called debits, very simple to understand, and on the right hand side are called credits. So this is a standard debit and credit. So in a T-shaped ledger, on the left hand side you will have debits, on the right hand side you will have all the credits in the P&L. And at any point of time, debit minus credit, the total has to match. So debit minus credit will have to be 0. Okay, now I've taken small example. For example, just imagine if the capital of a company is 1000 rupees and then there is some sale worth 500 rupees, and then immediately money won't come once you sell, so then there'll be a receivable of 500 rupees. So this adds to, let's say, 2000 rupees. So this is one side on the balance sheet, and on the other side of the balance sheet you will have inventory. So that means it could be uh, let's say 800 rupees worth of goods and balance 1200 rupees worth of claimable items. So the total of both sides has to match, which is what is a typical P&L account. Okay, now we won't get further into debit and credit because that will become too much of an accounting thing. So let's get further into things like indirect expenses. So see, what happens is while preparing profit and loss account, very two important items are, one is bad debts and other is depreciation. So what I am trying to explain now is how to treat bad debts in a profit and loss account. For example, I am a merchant and I have sold goods worth 1000 rupees to a party, and I'm only able to, let's say the cost of making those is 500 rupees, and I'm only able to recover part of the profit. Let's say the profit is 500 rupees. So that means the remaining loss which I will incur, let's say I'm incurring a loss of 250 rupees, that I have to treat in the P&L account. So that 250 rupees which I have incurred a loss is called a bad debt, and this is basically a loss which has to be treated in the year as a proper loss item. So how do I do that? So I will write, let's say, the cost, let's say, which is 500 rupees, and then ideally the profit, which should have been 500 rupees, and total sale value should have been 100. But then I will make a small change in this. I will make a small entry behind this, and I will write loss of 250 rupees. So my final calculation will become, the total amount will get reduced by 250 rupees in the P&L account. So the how it will look like: 500 rupees cost, 250 rupees bad debt, 250 rupees profit. So this adds up to 1000, and on the other side the sale worth of 1000 rupees is there. And so in the this is in the P&L. And how will it look in the balance sheet? Balance sheet, it will look like account receivables 1000 less the loss of 250, that means net 750 rupees, and your retained earnings on the other side, which is liability, will be 250 rupees. Okay, now this is how we treat entries on the bad debt or expense which we treat in the P&L. Another important thing is depreciation. Now you have to understand carefully, what does depreciation mean? Let's say I buy a car today in the name of my company. So the life of the car is certain number of years, maybe 5 years or 10 years, and let's say it's valued 10 lakh rupees. So how do I treat this car? Helps me make a profit of, let's say, 1 crore rupees. So how do I allocate the cost of the car? So therein comes the question of allocating a certain amount of expense every year. So let's say in the car, let's say 10 lakh rupees, every year I say only 1 lakh rupees worth of the car is used in my business. So I treat 1 lakh rupees every year as an expense. And whatever profits I make in that particular year, minus that 1 lakh rupees, will be the net profits. So this 1 lakh rupee of car expense every year is called depreciation. Now I explained you the concept. Now let's go to the definition. So definition of depreciation is nothing but the expired cost of a asset, or over, rather I would say, the expired cost over the life of an asset is called depreciation. So depreciation is very important because it's an expense, and it has to be a pro rata calculation of the expense, because entire chunk of asset is not used in one particular year. So we have to allocate every year this thing as an expense. So in the next video I will be talking about the various methods of calculating depreciation, which could be straight line method, it could be some other methods also complicated, but then basic concepts I've explained here, so this should help you grasp the next learning. Thank you very much for watching this video.